equity investment actually a smart way to tap your home equity, or could it cost you far more than a HELOC over time? If you've built up serious home equity but don't want to refinance into today's mortgage rates, you may have seen something called a home equity investment, sometimes marketed as no monthly payments and no interest. It sounds almost too good to be true, and the big question homeowners ask is, if there's no interest rate, what's the real cost? Today, we're breaking down a home equity investment, how it actually works, how repayment is calculated, and when it can become expensive, and how to decide if it fits your financial situation. And this matters right now because with mortgage rates higher than they were just a few years ago, many homeowners are looking for alternatives to refinancing. But not all home equity options work the same way. Let's unpack it clearly. Question 1. What is a home equity investment and how does it work? So a home equity investment, or HEI, it's not a loan. Instead of charging you interest, a company gives you a lump sum of cash up front in exchange for a share of your home's future value. There are typically no monthly payments, no interest rate, and no required principal payments during the agreement term. You pay the company when you sell your home, refinance, or reach the end of the contract, often 10 to 30 years. And what you repay includes the original amount you received, plus a percentage of your home's appreciation. So instead of paying interest, you're sharing future equity growth. That's the core trade-off. Question 2. How is the true cost of an HEI calculated? This is where the math really matters. Let's walk through an example. Your home is worth $500,000. You receive $50,000 from a home equity investment company. Now in exchange, you agree to share 20% of your home's future appreciation. 5 years later, you sell your home for $650,000. That's $150,000 in appreciation. 20% of $150,000 is $30,000. So you repay the original $50,000 plus $30,000. So your total repayment is $80,000. That $30,000 difference is effectively your cost. Now, here's the key. If your home appreciates more, the cost increases. If appreciation is modest, the cost is lower. Unlike a HELOC, where cost depends on interest rate and how long you carry the balance, an HEI's cost depends on future home value. Question 3. What if my home value goes down? Well, one reason some homeowners consider HEIs is shared downside risk. If your home declines in value, the investor's return may decrease as well. So let's look at another scenario. Your home starts at $500,000. You receive $50,000 for 20% of future appreciation, but instead of rising, your home sells for $480,000. That's a $20,000 decline in value. Now, depending on the agreement terms, the repayment amount may be adjusted downward. However, and this is important, many agreements include minimum return provisions, fees, or valuation methods that can affect the final calculation. So while the investor may share some risk, it's not unlimited protection. Understanding the contract details is critical. So why this matters now? Many homeowners today locked in mortgage rates between 2% and 4%. Refinancing into today's higher mortgage rates often doesn't make financial sense. So instead of refinancing, homeowners are exploring alternatives like HELOCs, home equity loans, and home equity investments. But in a strong housing market, giving up future appreciation could cost significantly more than paying interest on a HELOC, especially if you plan to stay in your home long term. The decision isn't just about accessing cash, it's about long-term wealth building. Question 4. How does an HEI compare to a HELOC? Okay. Well, let's simplify it. A HELOC is a loan, and it requires monthly payments it charges interest, and lets you keep 100% of future appreciation. A home equity investment has no monthly payments, has no interest rate, requires sharing future appreciation. So the real trade-off becomes this. Would you rather handle predictable monthly payments now or give up a portion of future equity later? There isn't a universally right answer. It depends on your financial goals and risk tolerance. Here are some common misconceptions. Let's clear up a few common misunderstandings. Myth number one, it's free money. It's not. The cost just shows up later. Myth number two, no interest means no expense. The expense is built into the shared appreciation. Now, myth number three, it's safer than borrowing. Now, it may reduce short-term payment pressure, but it increases long-term equity trade-offs. Understanding that difference is critical before signing any agreement. Question 5. When might a home equity investment make sense? An HEI might make sense if you can't qualify for a HELOC, your income is inconsistent, you need cash but want to avoid monthly payments, or you plan to sell in the near term. Because the shorter the timeline, the less appreciation may accumulate. But it may not make sense if you plan to hold your home for many years, you expect strong local home appreciation, and preserving long-term equity is a top priority. How to know if this is right for you? Well, ask yourself, how long do you plan to stay in the home? How strong is the local housing market? Can I comfortably handle monthly HELOC payments instead? Am I willing to share future gains? If cash flow flexibility is critical, an HEI may provide short-term relief. If long-term wealth building matters more, preserving equity could outweigh avoiding monthly payments. A home equity investment doesn't charge interest, but it absolutely has a cost. That cost depends on how much your home appreciates over time. For some homeowners, avoiding monthly payments may be worth sharing future gains. For others, keeping 100% of appreciation may matter more. So before deciding, compare scenarios carefully and understand the full agreement. For a full breakdown, including detailed repayment examples and comparisons, visit themortgagereports.com at the link below. If this video helped you understand home equity investments more clearly, like the video, comment your thoughts or questions below, and subscribe for ongoing updates on mortgage rates, refinancing strategies, home equity options, and housing market trends. We'll see you in the next video.